So I never heard of this Silicon Valley Bank until today, actually. Silicon Valley. I knew there was a Silicon Valley. I know there are banks. Stands to reason there's a Silicon Valley Bank. I'm not the biggest finance guy in the world, but I could have told you months, if not years ago, that this bank had a big problem just by looking at one of its commercials.
As an innovator, you're all about creating something new. And that's a journey we understand. At SVB Private, we're focused on serving the innovation economy by collaborating with the people who drive it. We can help simplify your financial life by anticipating your personal and professional needs.
That's it right there, anticipating my professional needs as we look at some couple on vacation on a scooter. This is, the words don't match the imagery. They weren't paying attention to detail. I'm serious. I think this is a hint to just how out to lunch they may have been. But I know you gotta lift up the hood and really attack the financials of this institution. And let's do that.
You know what it takes to find out what was wrong with Silicon Valley Bank. You needed to know it had a concentration of depositors. You needed to know that it had a duration risk in its portfolio. That duration risk was unhedged, and it had a series of problems inside of it that the supervisors you both have acknowledged and are beside yourselves couldn't see.
The duration risk, yes, of course, that was unhedged, and I don't know what he's talking about. So I'm not a finance guy. However, I again can see that this bank had big problems just on the surface. Take a look at their diversity, equity, and inclusion program. A month-long Pride campaign. Their blog emphasized mental health awareness for LGBTQ+ youth. Did any of them have accounts, I wonder? Safe spaces for coming out stories. How about a safe space for depositors' money? That's what we want from a bank. Wow, huh? They took this stuff very seriously, like a lot of corporate America, and it's ruining all of us, especially them.
I think what really sets us apart when we think about diversity, equity, and inclusion at SVB is our culture and our united desire to lead with empathy.
We proactively make it our mission at SVB to ensure that our clients, employees, and partners feel listened to and that their voices matter. So from funding underrepresented entrepreneurs to having multiple employee resource groups, I could not be prouder of working for a company like SVB.
It is all in what we do throughout the year, the space that we hold throughout the year for all of these groups, for everyone that feels that they have a space in one of these ERGs, and talking about it all the time, not just for Pride Month.
You don't need an MBA to understand that this bank is totally out to lunch like all of corporate America right now. This stuff is so fashionable. You gotta talk this language to even be eligible to do business, but it's ruining the business. All right. Now, I do want to take a stab, though, at the financials. We got to lift up the hood and get in there and really try to understand what's going on.
I think the greatest weakness in all this is the use of so-called risk-weighted capital measures rather than equity capital to assets, which takes in all their assets.
Okay. Risk-weighted capital measures instead of the equity capital-based. Maybe you do need an MBA to understand this guy. All right, I don't. But I have studied this, and I talked to some people in the game, and I think it comes down to this. All right, let's boil it down to our tech bro out there in Silicon Valley. All right, those guys want to change the world. They're always trying to invent the next Twitter, the next Facebook. And every now and then, one of them comes up with a very interesting idea. All right, good for him. Gets a big idea, and then he goes around to the venture capital people, and the venture capital people, if they like that idea, they throw money at him, sometimes a lot of money. So he or she can get that startup up and running. Now, he's got to find a place for all that money, okay? So Silicon Valley Bank has really advertised itself as the place to go for the tech industry, and it works out. What does the bank do? They take that money and, well, they hold on to it. They also do what banks do. They make loans and they charge interest. That's how they make money. And they also did something that apparently is done, but this might have led to its downfall. It invested in securities, government securities, and a lot of those were at a crummy rate. And a lot of them were very long term, 5 years, 10 years. Now, that apparently is not a good thing. It's better that you can liquidate this thing overnight, these things overnight, if you have to. So a couple of other things were going on. After COVID, the money from the venture capitalist community, that started to slow down. All right, so there weren't as many people getting the money from the VCs, and they weren't going to the bank with their money. It just got a little bit cold, all right? Does that make sense so far? Now the tech guys started to withdraw their money. Now, what precipitated that? About a week ago, they had to announce, the bank, that they had lost $2.2 billion on some of those government-backed securities that they bought, all right? That was a big worrisome data point that Peter Thiel noticed and started telling all of his smart friends in Silicon Valley, I don't know about this bank anymore. They just lost $2 billion on government securities. And then the word went out and everybody got nervous. All the tech bros were taking their money out of the bank. So everybody kind of panics, shows up at the bank looking for their money. And, well, you've seen it on the news at this point. However, in all likelihood, there's not enough money to pay everybody, at least not initially. A bank is only required to keep 10% of cash in reserve. And my understanding is, well, it's only 10%. You can figure it out for yourself. That's not going to satisfy all the depositors. Now, the federal government is saying that everybody will be paid at no cost to the taxpayer. No losses associated with the resolution of Silicon Valley Bank or Signature Bank will be borne by the taxpayer. The Wall Street guys I'm talking to don't necessarily buy that, but this is what Joe Biden himself is saying.
This is an important point. No losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund.
Or they'll just print more money and inflationary pressures will only increase. And oh, by the way, inflation probably led to this in large part. Joe Biden, of course, has blame for you-know-who, our favorite guy.
During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again.
Unfortunately, the last administration did something. So why didn't you come in on day 1, day 5, day 500 and fix that? Why didn't you do that? Because this is a cheap excuse. It's blame the other guy. He mentioned Dodd-Frank. That's for Chris Dodd, the senator from Connecticut at the time, and Barney Frank, House member from Massachusetts. Remember that guy? He shows up on Newsmax every now and then. Curiously, Barney Frank was actually on the board of Signature Bank, which just went down. The guy who wrote the Dodd-Frank regulations on his own bank couldn't save that one from failure. It's interesting. Probably not his fault. Who knows? I don't know. All right, back to the bank, the Silicon Valley Bank. And for the rest of us, I don't know. I mean, apparently, if you have $250,000 plus, you're not getting that back. And a lot of people don't think you should get that back. I feel a little bit funny about that, but this FDIC insurance that's been around for a long time, it's part of the deal, which isn't that bad. Depends where you're coming from, but take a look at this.
Since 1933, the FDIC seal at banks and financial institutions has signified trust and stability to millions of Americans. FDIC deposit insurance is backed by the full faith and credit of the United States government. Since the FDIC's inception, no depositor has ever lost a penny of FDIC-insured deposits. FDIC deposit insurance enables consumers to confidently deposit their money at FDIC-insured banks across the United States, and in the unlikely event of a bank failure, guarantees they can get their insured deposits back promptly.
All right. No depositor has ever lost a penny of FDI-insured money. That's a pretty good deal. Now, for the people online there at Silicon Valley Bank, apparently 90% of these accounts were in excess of $250,000. So we'll see what happens, okay? This is part of American history, though. It happens from time to time, these a run on the bank.